They made a key change, which was called the discovery rule, which really meant you don't have to be doing stuff that's new to the world, just stuff that's new to your practice or your business. Because of that, a lot of folks haven't heard about it. So if you've got a practice and you're doing $2.5 million a year, I would say you're probably looking at $25,000 a year to $35,000 a year, maybe.
Welcome back to another episode of the Full Arch Advantage podcast. My name is Gary Bird, and I'm the founder of SMC National, where we help you create, convert, and close more full arch cases so you can grow the way that you want. But you know what? The government's taking all your money. It's really hard to grow. And that's something that I've learned about recently. And actually, I had Derick, who is the founder of Big Life Financial, and he actually spoke at our event, and he shared some information around taxes that I've never heard before inside the dental industry. And I want to share them with you today. Number one, he's going to share how you can actually get a tax credit around research and development, because, you know, when you're doing full arch, you're going to be adopting new things, and sometimes those things work, sometimes they don't. And there's a way to write that off. I won't spill all the beans. I'll let him share that. And then number two, he's going to share how tax strategies actually should be proactive rather than reactive. You're not going to want to miss this episode. Stay tuned. All right, Derick. So why don't you break down for me how you kind of shared with our audience? You shared this and it kind of blew my mind, where you said, you know what, there's a research and development tax credit that dentists can take that most of them do not know about, especially if they're focusing on large treatment.
Absolutely. Well, I appreciate you having me here, Gary. The research and development credits are kind of little known within the dental industry for a couple of reasons. One is they have been around since the 80s, but when they first came out, they were really designed for like car manufacturers. They actually came about a little bit like some of these tax changes that happened during COVID, right? There was a crisis, the government responded. So in the 80s, up to that point, the United States had been dominating the automotive industry, you know, Chevy, Ford, Chrysler, those kind of things. And then the Japanese cars started coming over, the Toyotas, the Hondas, the Datsun at the time, which became Nissan. Yeah. And the US was falling behind. So Congress came in and said, hey, we need to find a way to help our people compete. We want them to innovate. We want them to do new things. So they created these tax credits as a temporary thing at the time. Well, it turned out they were so successful at helping companies to innovate and incentivizing them to do that they decided to continue them, and they kept re-ratifying them for years. And they made some changes over the years, because in the beginning, it was just for these big manufacturing companies. But then they broadened the scope. They simplified it so that smaller businesses could participate. And they made a key change, which was called the discovery rule, which really meant you don't have to be doing stuff that's new to the world, just stuff that's new to your practice or your business, okay? And that really opened it up. And then the tax code became permanent in 2015, finally. And that's really when this stuff truly became available to dentists. So it's relatively new. And because of that, a lot of folks haven't heard about it, right? So how the tax credit works is, like you said, the government knows that when you try new stuff, it doesn't always work out. And because of that, a lot of people don't try new things, right? Well, if you're doing full arches, you're definitely not in that category, but it does keep a lot of people from innovating or trying new stuff. So the government wants you to try new things. That's how we move science forward. That's how treatments get better. That's how software and technology gets better. Outcomes get better. Wound healing gets better. All of these things is by people figuring stuff out, by trying new things. So they want you to do that. And so the credits are really designed to help you to get some of the money back that you're putting into those types of activities and expenses. So when you try new technology and you have to train your team and you have to figure it out and you have to experiment on the first couple of cases or whatever, they know that that might cost you more than it makes you. So they want to give some of that money back to you. So in a service business like dentistry, a lot of these activities, it's the wages that go along with them. It's your team learning, it's you learning, it's figuring out new ways to do things. And so when you're doing all of that, it creates credits for you. And the credits are really predicated on what's called the 4-part test. And by the time I'm done with this, you'll probably know more than most CPAs about this, because it's kind of its own weird specialty. But in Section 41 of the tax code, which is the R&D tax credit, there's kind of 4 boxes you have to check within your business when you're spending dollars. The 4 boxes are you looking to improve a product or process?
Hey, I got something crazy to share with you, and I'm going to get you right back to the show, I promise. So we have an event called AlignerCon coming up next year, and this month we're giving away a buy one, get one free. We're going to be partnering with ClearCorrect, and this is going to be one of the biggest events that we've ever done in Nashville, Tennessee, in the biggest hotel in America. If you want to come to this, Again, we're going to give you a buy one, get one free. We want to meet you in person. Just go to alignercon.com and we're going to teach you how to create, convert, close, and even some clinical components around clear aligners. So don't miss this event. Go check it out now. Back to the show.
Well, in dentistry, when you bring these new things, you're working on a process, right? Trying to make it better, smoother, more effective. Is there a process of experimentation? Well, when you bring in something new that you haven't done before, or you upgrade something, or you change how you're doing something, of course, you're not sure about the outcomes, especially when you're dealing with the human body and new technology. So you're checking that box. Is it based in hard science? And this is where a lot of businesses don't qualify. Like my business, we're not necessarily doing hard science, right? We're doing financial strategy. We're doing tax strategy. You guys are obviously working in science, and specifically they state in the tax code, the 4 sciences are engineering, biology, computer science, or physical sciences. And a lot of dentistry is dealing with, of course, biology and the physical sciences. I'm sorry, well, not physical sciences, but the computer sciences. Physical science kind of creeps in there a little bit, right? And then the 4th box is, are you looking to reduce technological uncertainty is how they say it, which means, are you looking to get more consistent outcomes? When we do an arch, we know what the outcome is going to be of that arch, as opposed to the guesswork that might go into it. So realistically, when you're bringing new stuff in to do full arches or to do bigger cases or to do sleep dentistry or whatever you're doing, you're often trying new things. You're bringing in higher level of diagnostics, new equipment, new devices to allow you to do it faster or with less pain or faster recovery for the patients. And there's a learning curve to that. So the credits really apply to those types of things. This isn't like your day-to-day general dentistry. This is really like when you're bringing in new stuff. And most dentists these days, the speed at which the dental industry is progressing is pretty amazing. Every single year, it seems like there's new stuff coming out. So a lot of dentists are making these type of investments on a yearly basis. So most of our dentists that we've looked at, especially the ones doing bigger cases, are qualifying for pretty significant credits.
So when you say significant credits, like what, let's give a number to it, right? Is this enough for people to actually take the time to look into something like this?
Yeah. So I'm not going to do it depends, right? Because it does depend, but I want to give you some realistic numbers from what we've seen. I would say it's between 1 and, for higher tech dentists, maybe 2% of gross production. So if you've got a practice and you're doing $2.5 million a year, I would say you're probably looking at $25,000 a year to $35,000 a year, maybe. We've definitely seen higher than that. We've also seen lower. It kind of depends on the year and what the investments are you've made. But I would say a 1 to 2% of production for a high-tech dentist is probably where we're looking.
So it's some serious money.
It is, especially because the first year that we do it, we can do a 3-year look back. And
I love that when you can do that. That's really cool.
Yeah, so we can go back and amend for past years, help you get back a bunch of the money that you've already paid in taxes. Or if you're like a lot of our clients and you filed the employee retention credit and now you owe some taxes, in a lot of cases, we'll do the research and development credits. It'll offset a bunch of the money you had to pay in for those additional taxes. So it's kind of a nice trade-off there.
That's huge. Okay, so then what can you do from, like, what are the situations where this doesn't make sense? Like who doesn't qualify for this? I know you said like GP, but what are the situations where people are like, this doesn't make as much sense for me?
Yeah, and I want to be a little bit clear on that. A lot of the general practitioners who are out there, they do qualify as well, as long as they're doing new stuff. It's just some of them just have done the same bridge and crown stuff since the 90s, right? So those aren't as good a candidate. But generally, if you're paying taxes, right, first couple of years in a practice, a lot of folks aren't paying a ton of taxes because they got a lot of write-offs. These credits obviously have to have some tax liability to offset. So if you haven't been profitable or you haven't been paying taxes, this is something that we can do in the future for you, but for current years or the years you're not paying taxes, it wouldn't be a good fit. So a lot of new dentists, not quite there. And also if you have a very small practice, and a lot of times, once again, this is for newer practices, if you're under $500,000 a year, it probably doesn't quite make sense to do it yet. There's just, you're going to get $3,000, $4,000, $5,000, and that's almost not worth your time. It's better to just wait and do it in a future year, and then you can apply the credits toward that. So those are the two biggest things I've seen with dentists. Or I suppose if you haven't bought any new equipment or made any changes in the last 3 years, then, and I haven't seen a lot of that, but I know it exists. then you're probably not a good candidate. But yeah, if you're making over or bringing over $500,000 of production through, you're paying some taxes. I would say at least 10 grand, which most dentists are by the time you're hitting that. And if you've made some changes or improvements in your practice, it's definitely worth looking at. And we do free estimates for everybody. We want to make sure before you say go on it that it's going to be worth it for you. So we'll do a free 1-year estimate, look at it, make sure it makes sense, and then we'll take it from there if it does.
Yeah, that makes a lot of sense. So, and then lastly, I want to just quickly ask you more personally for me. So it seems like every year around taxes, right? Like I get to the end of the year and I'm scrambling. I'm either scrambling because we made too much money, but not enough profit, and we owe these taxes, or we made too much profit and, not enough money to pay, or vice versa. You get what I'm saying, right? And it's like always like, then in January, we're like trying to figure out what did we do for the year. You said something that kind of was like, yeah, you should probably plan that a little bit ahead, Gary. Could you break that down for me and help me understand, like, how should a dental office should be approaching this, especially dental offices that have, groups, or they're making a bunch of money? How and when should they be thinking about their taxes?
Hey, sorry to interrupt the show, but we got a quick segment for you that's called Ask Gary, and we have some people that have been sending in marketing questions that I think will really help you. If you'd want to send in your question, all you have to do is send in an email to askgary@smcnational.com, or you can leave a comment or DM us, and we're happy to answer it that way too. So today's question comes in from George, and his question is, what does a good marketing budget look like as far as the dollar amount? And if this is a really hard question to answer because it really depends on what your goals are. So I'm not going to answer it in dollars, but I'm going to answer it in percentage. Rule number one is never ask a marketing guy, how much should we spend? That is the worst thing you can ask them, because they want to spend to the moon, right? Really what you should be looking at is the percentage of your total revenue in marketing budget. So you want to take a percentage. So 1 to 2% of your total revenue is a really small marketing budget, and you're probably not going to grow. So if you make $100,000 in total revenue every single month, 1% of that is going to be $1,000. 2% would be $2,000. If you are going to really want to grow, you have to be above 3% or more to be able to grow. And if you want to really see explosive growth, usually that's going to be in that 4 to 7% range. Now, when you get into massive growth, or really needing to like add an associate, or you added a bunch of new operatories that you need to fill, you added new hygienists that you need to fill their schedule, then that's when you get into that like 6 to 10% range. And that's the general range, 1 to 10%, depending on what you're trying to do. Obviously, this is for GP. When you get into like full arch marketing, your budget can be as high as 20% of your total revenue, because that's a totally different beast. So hopefully that helps you.
Yeah. You're funny, because it's like when I'm having my turkey dinner on Thanksgiving, about the time it hits my digestive tract, I start getting phone calls, right? Everybody's like, oh my gosh, it's the end of the year. It's time to figure out my taxes. So honestly, we think September-ish, which is right when we're recording this, is about the time to start looking. And here's why. 9 months into the year, you have a pretty good idea of how much money have we made? What track are we on? Is it going to be a good year? Is it going to be a bad year? If there's any big expenses like an office remodel or something like that, you're aware of those expenses, because those don't usually just come out of nowhere. So we start looking now. We do a projection based on how the first part of the year's gone. We kind of project that forward and say, okay, you're going to end up at a certain income level. And we want to get you to a certain income level. And it varies a little bit from client to client, but just so that everyone's aware, you kind of jump into the big kids tax brackets around $350,000 of taxable income between you and your spouse. It's about half of that if you're not married, so it's $170,000 for a single person. But at that point, you jump from the 24% tax bracket to the 32% tax bracket, and at that point, you have some state on top of that for most people in Social Security. So in a typical state, I mean, I know there's the Texas and Floridas that don't have any state taxes, and then there's the California and New York's that have double what everybody else has. But for a typical state, over $350,000, you're probably paying 40% or more of your income in taxes. So it's pretty expensive. So what we're looking to do is, especially when your income's going to be over that, and most of my dental clients, if I'm honest with you, make between $400,000 and I would say $1 million a year. We have some above and some below, but probably 80% of them fall in that category. So they're all playing in that the 40% plus tax bracket. So we want to be looking at it right now, doing a tax review, looking at how the year's shaping up, and then evaluating what are the tax strategies that are out there that you can put in place between now and the end of the year. Now, the difference between what we do, Gary, and like what their CPA does is a lot of times their CPA will come in after the fact and record and help to properly classify what they have done. But most CPAs don't know about tax advantaged investments, or they aren't licensed to go out and bring those to you. They're not entity structuring pros. They aren't necessarily specifically experts at donations and leveraging those, and other kinds of specialty insurance. There's all kinds of things that you can do to help to reduce your taxes. And everybody's situation is a little different. That's why we do the reviews. It's not just a one size fits all. Depends on your actual income, depends on how much cash you have available, because some guys are running a little bit tight because they made some big investments, and other guys are sitting on tons of cash because they never spent their PPP from 2 years ago, right? Or whatever. So really depends on your situation. But this gives us about 3 months to educate you on what the options are based on your situation, and then get you up to speed on how those would look, work with your CPA to get those implemented before the end of the year. So now you've got a really good tax plan. And then if we want to take it to the next level, most of these guys that you're talking about, they're getting hit on taxes year after year. Most people think of taxes in a single year period, right? Like 1 year at a time, usually in December. So if you think about it, if you planned your business that way, and you only looked at it 1 year at a time, it would be very different than when you're looking at multi-year strategy. Taxes are the same thing. If you start looking at taxes multi-year, where am I going to be? Especially when you're working toward an exit, or you've got some big years coming, or you just had some big years, looking at how can we be smarter about how we set things up and put money into things or create things now that are going to create tax breaks in the future. There's a lot more that can be done when we're looking over the course of multiple years versus just 1 year at a time. So tax planning gets into that too. And I just feel like most people think their CPA is the one that's supposed to bring all this to them. And it's not what they do. Most of them will help you pay yourself right. They'll help you to optimize a few things and write some stuff off. Maybe if you're trying to decide, should we lease something or buy something, they'll help you with that decision. But the reality is they're not tax strategists. They don't create the tax breaks. They record them, unless there's somebody really special. So that's the thing that most dentists are just missing is that planning.
Got it. Awesome. Now, if someone has questions about this, what's the best way to get in touch with you?
My website's biglifefinancial.com, but we do have a special page, biglifefinancial.com/SMC, and they can opt in for a free tax review. We'll have you fill out a small form so we can get some basic information, and then we'll get together with you and go over what we see as options. Obviously, we don't just do this stuff boilerplate, so we want to understand your situation. But yeah, we can really help you to start understanding your options and then pick the ones that make the most sense for you for this year and for the future, and get those things put in place. So biglifefinancial.com/SMC.
Awesome. Thanks so much for coming on.
You got it, man.